Alright, to understand the golden rules of accounting, we must first understand the types of accounts. The account classification applies to all the types of GLs. In other words, every account will fall in one of the three broad classifications as shown: real, personal, or nominal. A real account is a GL account relating to assets and liabilities other than people accounts. These are accounts that do not close at the end of the year and are carried forward. The examples could be GLs related to cash and fixed assets. A personal account is a GL account connected to all persons like individuals, firms, and associations. Whereas a nominal account is a GL account pertaining to all income and expenses primarily. Let's look at few entries to understand them better. Alright, let's say this is the trial balance of ABC Bank, and we are going to record some entries in it. Let's say the first entry is customer Ram deposits 100 crores in cash. When we look at it, there are two accounts: Ram, which is a personal account, and cash, which falls under the category of real accounts. And we know for personal accounts, the rule is you credit the giver. Whereas for real accounts, the rule is debit what comes in and credit what goes out. Since the cash is coming in, we are going to debit it. So the entries would look something like this. On the liability side, which is the credit side, we'll say depositor Ram, and since this is a personal account and he has paid us some money, we are going to credit the giver 100 crores. And on the debit side, why are we entering cash on the debit side? Because cash is real account, and since it has increased, it has come in, we are going to debit it. So cash increased by 100. On the asset side, on the liability side, or the credit side, the depositor balance increased by 100. Alright, let's say the second entry is the bank purchases a building for 10 crores in cash. The two accounts involved here are building and cash. Building is a real account, so is cash. And we know the rule for real accounts: debit what comes in and credit what goes out. What's coming in is building, so we are going to debit it. What's going out is cash, so we are going to credit it. So let's see how would it look on the trial balance. So on the debit side, a building will come. It's going to increase by 10. Whereas the cash, since it went out, we are going to credit it. Since cash is a debit balance, crediting it means we are going to reduce it by 10. So minus 10. Alright. Let's look at another example. Let's say the ABC Bank pays a salary to its employee of 2 crores in cash. Alright, so two accounts involved here are the salary account and cash. We know cash is real account, whereas salary being expenditure, it's part of nominal account. And we know the rule for the nominal accounts. What's the rule? Debit the expense and credit the income. Since this is expense, we are going to debit it. And for cash, we know the rule: Since it being a real account, we know the rule is debit what comes in and credit what goes out. Since the cash is going to go out, we are going to credit it. Now let's look how would it look in the trial balance. So we paid a salary. Salary is going to come on the debit side because it's an expense. We are going to debit this nominal account by 2 crores. And since cash got reduced, we are going to credit it by 2. So this is how the trial balance looks now. At the end of the 3 transactions, let's see if the trial balance is telling. So on the left hand side, the credit side, the total balance is 100. On the asset side, also we see these two entries are cancelling out. These two entries are cancelling out. So essentially this is, there's 100 on the asset side as well. So we can say the trial balance is telling.